how did banks go from this?
The money's not here. Well, your money's in Joe's house. That's right next to yours. And in the Kennedy house, and Mrs. Maitland's house, and 100 others.
To this. In this video, we'll talk about what banks used to be, both in terms of the retail and business sides, what modern banks do, and then look at the socially worthless world of investment banking. So business banking emerged to serve small growing enterprises by providing them with capital at various stages of their development. Of course, corporate bankers do continue to fulfill this role, just less so. At the top end, the corporate bond market has largely replaced bank finance. At the bottom end, angel investors and venture capitalists have edged aside your local bank manager as a source of early stage funding. In the meantime, in an effort to reduce balance sheet risk, banks have turned to the commercial and residential mortgage markets, helping to feed a series of real estate bubbles. This shift has been encouraged by bank regulators who favour the security theoretically offered by property collateral. The retail banks historically provided a personal and hopefully usually friendly service to regular on the street people like you and I. Classic services included the provision of current or checking accounts, deposit and other savings products and cash handling. On the lending side, banks offered personal loans and car loans, while traditionally mortgages would have been secured from a building society or savings and loans in America. The major banks pushed their way into this market in the 1990s and have been dominating it ever since. Hello, CDO squared and all that nonsense. We'll get onto that. In the realm of modern personal banking, gone is your local bank branch, your supportive familiar bank manager and helpful patient cashier. All have been replaced by the nightmare known as online banking. This was sold to customers as representing progress and convenience, and banking apps certainly feel easier than visiting a physical bank branch for essentially routine financial transactions. This convenience has come at a cost though. Today the average customer, especially the elder customers, have to spend their life anxiously on the lookout for scammers. And I'm sure we've all had the joys of dealing with attempted fraud, holding for hours on a call to a help desk to speak to a poor operator, or trying to converse with a delusional chatbot named Vera or Dante, not to mention the tedious process of replacing cards and passwords, and I despise the verification code you get every 5 milliseconds. And the best part is that every time you try and withdraw or move a large amount of money, you are challenged to prove that you are who you are and not some sort of Russian money launderer. Now, as customers, did any of us ask for these changes and complications? No, not really. In reality, banks adopted all of these technologies, both back office and customer facing, to reduce costs, particularly in the face of the competitive threat of new entrant challenger banks like Monzo or Starling. So who is it that's actually benefiting from all the technological innovations? Funnily enough, not really the banks. Bank profitability simply hasn't benefited from 25 years of cost cutting. Just ask the long-suffering bank shareholders. Haha, I'm not one of you. Nor have the bank's staff. The sometimes cordial and pleasant customer-facing jobs at your local branch have been replaced by a miserable existence in contact centers taking calls from angry customers. But what about us, the customers? I mean, we've seen an improved and more efficient service. Well, in some ways, yeah, tap tap. In some ways, no, clickety clack. It's really been a mixed bag, and it's definitely not clearly been beneficial to us all. But circle back. Who have been the beneficiaries again? Fraudsters. Yes, fraudsters and scammers have been the obvious beneficiaries. In recent years, the level of their take has left the proceeds of an old-fashioned mass bank robbery looking like chump change. According to an analysis from the Federal Bureau of Investigations, losses connected to cyberware complaints were $12.5 billion in 2023, up $2 billion year over year, and more than triple the amount recorded in 2019. Despite the number of complaints less than doubling compared to 4 years prior. The secondary group who have really benefited have been technology giants. Selling all that expensive hardware and software to the banks and their customers has been hugely lucrative for big tech. Let's contrast Microsoft's 20-year share price graph with that of Bank of America's. Yeah. Of course, Bank of America's abject share price performance cannot be laid exclusively or even mainly at the feet of digital banking. Egregious behaviour in the run-up to the financial crisis and the outrageous compensation paid to its horde of investment bankers are largely the primary culprits. However, owners of the retail banks can only look enviously at the share price performance of the software suppliers. It would have been nice if banking management had secured a little bit of the upside for the customers, staff, or their own shareholders. Now, banks still perform many of the functions of ye olde building and loan, with my terrible American accent, but that's not really what most of us think of when we think of a modern bank. We think of Wall Street, too big to fail, huge salaries, and smug self-certainty second only to my own. We think of investment banks. It's quite challenging to find any services offered by investment bankers which create any real value. The cheerleaders would propose that some of their clients benefit from specific advisory services that would include sensible merger and acquisition strategies, some treasury support at a pinch, foreign exchange hedging. That's about it, and that's us being a little bit generous. Now let's consider some of the costly services they claim will benefit their clients, which we regard as at best questionable and at worst actively harmful. The genius of this industry has been to convince people that they need to exist. The best trick the devil's ever played is convincing us that we need to pay him 5%. That's another reason why this channel is here, to point out why these huge services don't need to be here and to save you from falling into the machine that is designed to make your money their money. So, in no particular order, we have unnecessary and often value-destroying mergers, acquisition and restructuring advisory services, foreign exchange trading, where for every genuine foreign exchange transaction necessary to oil the wheels of international trade, there are thousands of speculative bets between one bank and another on if the price will go up or down. Private equity, where excessive amounts of leverage are used to promote short-term investors, squeezing the life out of helpless companies, milking every penny they can while ignoring the company's long-term needs and the needs of their loyal staff, who are, by the way, often left to deal with the absolutely terrible infrastructure of the company and then unduly fired and swept under the rug while the people managing it scoop out all of the money they can. It's just disgusting stuff. Manic, or they would call it high frequency, bond and equity trading, some on behalf of the clients, others on their own account to generate unearned profits. Creating and trading derivatives, which are complex financial instruments which all too often their own creators don't even fully understand. Do you remember CDO squared? Do you remember all that? Do you remember the world economy collapsing because of the... Yeah, that. Biased and largely pointless investment research, and expensive and overly complex asset management, where exorbitant fees are charged for ultimately very mediocre performance. Now, outside of any other moral objections you can and should have to a lot of these services, the biggest thing you should be noting is that these services are designed principally to make money for the banks, not their clients. In fact, mostly they represent a large and unnecessary cost to business. Now, we suspect if you let Musk or his former Doge team loose on Wall Street, they can eliminate most of these activities without anyone in the real economy noticing? Apart from local Porsche dealers, Rolex retailers, and the odd upmarket Manhattan real estate broker. I don't feel too sorry for them. Now look, you won't hear anyone in politics, the media, and certainly not from the world of finance giving you this message, as it would likely lead to a loss of livelihood. We, on the other hand, have no hesitation in telling you the whole truth. This is the unacceptable face of capitalism. Investment bankers care more for their own profits and bonuses than the financial outcome of their clients. Some very smart, well-educated brainpower is wasted on ultimately unproductive economic pursuits. This is investment banking, and it is, as we said, socially, completely, and utterly worthless. That's about all there is to the modern world of banking. Now, of course, there's many nuances and little details and wrinkles we can go into, but as a sweeping overview, we think this is pretty decent. Follow along for more financial education. We hope you enjoyed this one. See you in the next one.